Hello student, welcome back to IBS. Now we will understand about other comprehensive income. As you can see, this is unusual gain and loss. First we will understand about the definition. Unusual gain and losses are items that significantly affect financial performance but are not part of regular business operation, and there are transactions or events that are rare or infrequent but not extraordinary. They can distort the picture of normal business operation and needed to report it separately to provide clarity to financial statement user. For example, insurance recovery, sale of non-operating asset, and other write down the inventory. If you are writing down with regard to damage kind of stuff, so that is also unusual gain or loss. And restructuring changes, okay, these are the example of your gain and losses. Insurance recovery in the sense from insurance claim due to damage not related to normal business activity, so this will be your insurance recovery. Sales of non-operational asset, gain from selling asset not related to core business, such as selling the piece of land which is not generating any revenue, or this is not part of your normal operation. So if you are selling this, that will be your unusual gain or loss. For inventory point of view, significant reduction in the value of inventory due to obsolescence, damage, sudden drop of the market values. If market is dropping down the product price, so that is why it is called unusual gain and loss. Restructuring changes, costs are associated with reorganizing and downsizing, such as severance pay and facility closure. I hope it is clear to you. So where you are going to report all these non-usual gain and loss, you will report this. This is the place which has been created for this unusual gain and loss. You will report here. That is again net of tax. Whatever, if you have any gain and loss, you have to adjust the tax. Reporting, usually disclosure separate on income statement. This is separate. I mean, from here your net income is already considered and you have paid the tax also. This is the main operational, and this is the other than your main operation. That is why this is saying that usually disclose separate on the income statement just above the income from operation before income tax. This is the thing which they are referring. Different from extraordinary item, unusual item are shown separately but do not qualify extraordinary. So this is not extraordinary, this part is the extraordinary. Now we'll discuss about, so these are the item are not considered extraordinary gain or loss. That I will discuss this later, then you will know the better what I am trying to say. This is unusual but that is not extraordinary. This is the meaning we are trying to say here. Discontinue operation, for example, discontinue operation are referred to the part of business that have been disposed of or are being held for sale and where the company no longer has significant involvement in the operation. For example, their types are sales spin-off. What does it mean? When a part of business is being separated and operates as a new independent entity. So you have company in which 20% of your particular company from equity you are separating it and making another company and registering with new name or something. So they are independent now. You're not considering as a what you call under your equity section there is a non-controlling kind of stuff. In that any other equity part you are not considering, you have removed fully along with their asset and their liability, asset and liability, everything you have removed from your main and consolidated balance sheet and you made him independent company. So that is called a spin-off. So that is again being considered as a discontinued operation. And another point is sale of business segment, when a company sell a particular division or business unit. Okay, so that is also called discontinued operation. And abandonment of business segment, what does it mean? When a company discontinue an operation segment and abandon it without selling it. So we are abandoning it but without selling. That is also discontinued operation. Also wanted to discuss two more point here. Abnormal loss point of view. Normal loss are normally loss related manufacturing, and that losses occur due to event or condition that are not typically normal production process. In normal production process, when we are defining our standard rate, that time we are considering marginal losses with regard to raw material production, labor shortage, and labor are not effective, they are not working 8 hours, they are working 6 hour or 5 hour, whatever it is. Raw material when we are purchasing 5% are normally damaged kind of stuff. So these are the thing we have considered, and then we have defined our standard rate. But if standard rate is 10, and if it is going beyond that, going 15 or 20 like this way, or maybe 11. So if after considering all of this, what is the reason of increasing this standard rate? If that rate is because of, if it is 5%, it is going 10% or something, so that will be your abnormal loss. For example, you have one tray of eggs, and normally in that tray there is one or two eggs are damaged. But if it is fallen and out of 30 eggs, only 2 or 3 eggs remain safe and rest all 27 eggs are destroyed. So that is called abnormal losses. So normally this happen because we are doing some activity. So these are the abnormal losses. This occurred because of damage of inventory, production failure, or regulation or fine if you are not following the normal regulation and rules. So that is also cause of your abnormal losses. Government may charge you that penalty kind of stuff. Abnormal loss is manufacturing if significant or infrequent would be classified as unusual losses and reported separately in the financial statement. This separate disclosure helps to distinguish these rare losses from regular operation result. From regular operation, this is the result, but this is not normal losses. This is abnormal losses. So you have to separately classify these. So by making this kind of disclosure, company provides the clear picture of this financial health and performance, ensuring that unusual and extraordinary event do not obscure the result from ongoing operation. So we are not hiding anything. We are explaining and giving the report. This is the main perspective of giving extraordinary as a separate line item in the income statement. Okay, now we will discuss about extraordinary income. So this is our extraordinary income. So this is unusual in nature, high abnormal. This is abnormal, but even higher abnormal level, unrelated to company typical activity. What they are trying to say, unusual event or transaction should be highly abnormal and not related to company typical activity. Infrequent in occurrence, the event or transaction should be something that company does not expect to recur in the foreseeable future. We are not thinking that should be happening in future. For example, losses due to damage from the rare natural disaster like earthquake. Whatever we have discussed in the abnormal losses, that is extraordinary item. So this will be your part of your place where you can update your abnormal losses separate. So we are not clubbing into these places. Okay, we are not clubbing here, we are clubbing it separately. So that is why I was explaining here, so that you can understand. Okay, so that is why I was explaining this into this slide. Okay, because I have already pasted the income statement so that you can easily understand. So that's why separately we are updating all our extraordinary abnormal losses here. What is the key point? Extraordinary item are reported separately. We have already discussed. Infrequent nature, typically appearing below income before extraordinary item. Name itself is saying extraordinary income is about to come after this. So this is the structure we follow in creating income statement. Intra-period tax allocation, this is the same thing which I have keep on discussing with regard to net of applicable tax. So whenever we have any gain or loss, for that we have to consider the tax, and that tax will go to your actual tax with regard to your net profit. From here, whatever the tax we have, from there all the tax coming from this part, from extraordinary gain or loss, gain and loss from operation, from discontinue or disposal. So those tax will be adjusted from your main tax. This is the point. Okay, so now we need to discuss about non-controlling interest. That is also very important to know, and this is also, I would say, quite tricky also. Sometimes we are not able to understood fully, or we get confused sometimes. So that is why when I'm explaining, I am expecting you should be carefully understanding and trying to learn this. So what is the meaning of non-controlling interest? In balance sheet, your equity section, you will have return earning, your share capital kind of stuff, preference and other kind of stuff, and your current year earning. Also you will have non-controlling interest, that will be separate. Similar to this, if it is 1, so then it will be 2, it will be separate, but this is the part of your actual equity. So these are the equity of owner, and this is the non-ownership equity part, but still they are maybe co-founder or kind of stuff. So you have 10 different business, and out of 10 there is one business in which you are not having the 100%, you are owning that business around 80%. So 20% this another guy is holding. So that one business out of, so their equity part will be separated so that it will represent that there is non-controlling interest. So we are done for the day. We'll see you into the next session.